few weeks ago, I posted a video up here in regards to just determining direction through cumulative delta. After the fact, I had a couple different conversations. Questions came up in regards to some of the things that got covered in there. And one key thing in particular, I said, oh yeah, that needs to get talked about. So that's really just the whole point of this video, is to go over a couple of different things that might have been missed that are really crucial to just getting this concept around your head overall. So we're using NinjaTrader today. No particular reason. I'm just flip-flopping back and forth here, trying something else out here today. But basically, you're looking at gold. Last time we were looking at crude. I have a crude chart over here as well. We'll take a look at that in a second because it relates to really just the whole point of this video. And the main thing that I wanted to discuss was just how these instruments vary one by one. Just they all have their different characteristics, as you know. Okay, so if you're trading FX, GBP USD moves very differently than Euro USD, and so on and so forth. Okay, now when you're swing trading things, a lot of those movements, they don't get nullified, but they're of less importance as opposed to when you're doing something like day trading, and timing is absolutely crucial. So when you're taking just a few ticks out of the market at a time, and by a few, I generally I'm talking about anywhere from 10 to 50 or something like that, typical day trading type of stuff. These movements are going to be you need to get them ingrained in your head. Let's put it that way. Now, when you're looking behind prices, the reason prices look different and behave different is because what is hitting the tape is very different from instrument to instrument, and it doesn't necessarily always boil down to how much volume is getting traded. What it really boils down to is the ratio of limit orders to market orders hitting the book. So in other words, if you're trading a very saturated market, like any kind of treasury, it doesn't matter the year, they're all pretty saturated. What you're seeing there is just a ton of limit orders in relation to the number of market orders hitting the book. Okay, and that's why prices don't move very much. They just get stuck a lot of times because those limit orders create a tremendous amount of friction, and prices are not able to achieve certain objectives. They can't uptick or downtick as easily as they can in a market like crude oil, where the number of market orders hitting the book are just, in relation to the number of limit orders, is much more severe. Okay, so I'm just going to show you something really quick. I don't want to get too distracted by this. This is Jigsaw. Most of you, or some of you may know this, some of you may not, but basically it's just a sort of a I don't say more advanced, but it's just got a lot of features all surrounding the depth. So this is crude oil, and what you'll notice in your center columns here is you're just basically seeing, in relation to the numbers surrounding prices themselves. In the middle column, we have finalized executions, what's hitting the bid, what's hitting the offer, and then in your outer columns, you have what's commonly referred to as liquidity, which is just resting order flow. Okay, so these are orders waiting to be executed or pulled, giving on the situation here. So what you're seeing here is, when you see 134, 116, so forth, you're looking at, and then you compare them to what's sitting on your side panels here. You can see that, again, your market orders to limit order ratio is, it's relatively high in that sense. All right, then you come over to a market like gold, okay, and I'm not going to show you the panel, but basically in gold, that limit order ratio is going to be higher. Okay, you're going to have more limit orders than you would in a market like crude. So therefore, your delta is going to look different as well in relation to prices. Okay, and this is really the primary thing that tends to shift really chart behaviors overall. Okay, let's put it that way. Now I'm using gold because gold is, I don't want to say it's overlooked, but for a lot of day traders, I think it is. Gold is good because number one, it's easier to get a leash on from just, again, the order flow side of things, and I don't like tossing that term around, but it's easier to get a leash on, and it moves. Okay, it's relatively active. All right, it's not just going to sit there and cycle around all day and drive you nuts. Okay, And then crude, on the other hand, I use the analogy in one of my conversations where, when I'm trading crude, I feel like I'm performing surgery because, my attention needs to be so much more peaked when I'm trading crude because a lot of these nuances that, I'm looking for that are just very easily visible on gold, and I'll show you in a second, they're a lot less pronounced on crude oil. And bottom line, I just have to be a lot more careful, okay? So again, the relationships are different, and it's very important to realize that. So let me explain that in a little more detail here. So back to gold here. Let's start with the easier stuff. Okay, now let's first start with delta, and again, delta is just number of executions on the bid versus the offer. All right, so if we're hitting the bid, we are red. If we're lifting the offer, we are green. Okay, now when you compare this to prices themselves, okay, like we talked about in the last video, we're looking for prices to lead. Okay, so we're looking for hidden divergence where limit orders are having a material impact on price. Okay. And why are we doing that again? Again, it's all about the path of least resistance. All right. If I have a wall of limit orders standing in my way, prices will not progress forward. Okay. Now, with an overwhelming number of market orders, they will. Okay. But to say once again that market orders are going to win all the time is sort of a naive assumption. Let's put it that way. Okay. And it's not a mistake that you want to be making. All right. Gold does not behave as much like something like index futures. Okay, so everybody starts off trading. They start off trading either Euro USD or E-mini S&P futures, which, frankly, in my opinion, after doing this for so long, they are not the easiest instruments to trade for a few different reasons, and the main reason boils down to liquidity. All right, so when we're looking at something like gold here, I'm just going to focus in on this upper tier over here, and let me get my pointer on. So as we came up, you can see we have several aggressive spikes just in terms of market orders coming in. All right, and then we start to taper off. And at this point, overall for the length of the movement, we're more or less 1-to-1. Okay, until we get up in this general vicinity. All right, and you start to notice we have a huge dip here. Okay, then we have a dip here. Okay, and then right around here where we have lower volumes, that's what the yellow is signifying. You'll see that as we traded sideways as far as our delta was concerned, but we started going lower in terms of prices. So what does that tell me? That tells me immediately that the path of least resistance right now, at least at this specific point in time, is to the downside. Okay, so I don't want to be going long here. All right, so I'm looking for another transition before I'd think about doing that. Okay, but bottom line, I don't want to be going long here based on this alone. So if I come over here, here's another great example. We just had a huge spike in market orders to buy, and yet look what prices are doing. Okay, they just halted. Okay, they're stopping. They're not making nearly the advances that my delta is. Okay, so what does that tell me? That tells me I've got a lot of limit order pressure up here. Okay, now can market orders break that? Sure they can. Do I want to go long here? No way. Okay, the reason no way is because, again, I know I've got a lot of pressure up here that's pushing down on prices, a heavier hand of the book that's more powerful than these guys, that I basically don't want to mess with. Okay, now that could change. Okay, we could get caught in a range here, and then all of a sudden, we could basically start buying. But at this point in time, I don't want anything to do with this as far as a long trade is concerned. So over here, let's just go back to here. I know I'm flip-flopping a lot, but if you come and see, now we have a low volume bar. Sorry, it's hard for me to do this without wanting to get into this. So the low volume bar is basically an earlier sign of exhaustion. Okay, now we have red coming in over here, so that they're hitting the bid, and price is following up with that, and down we go. Okay, so if we go over here, again, path of least resistance, prices are going down, delta is not, path of least resistance is to the downside. Okay, then we come over here, we made basically a double bottom on our delta. Don't try to look for patterns in here too much, but basically what's happening over here is we start to come together again, okay, where prices are more or less in line with what's going on as far as our delta is concerned. All right, and as we go up higher in delta, we go up higher in price. All right, we're making new highs here, we're making new highs here. Everything's great. No divergences though, or anything really worth noting. Okay, and then over here, look what happens. Okay, we start to sell off here. We get a little pullback in price. All right, now if I hit this same area down here, look what happened. Okay, we came right back down to these lows over here. So what does that tell me? That tells me there's limit order pressure to buy in here. Okay, it's hidden divergence. Price is leading my delta. Got it? So we want to buy. All right. Now again, this relationship on gold is very different oftentimes than it is on something like crude oil. Okay, and that's the whole point of this video, really. So let's go over to crude oil. I'll show you what I mean by that. Let's see if I can find some examples here. So you can notice here, down, 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 down. Okay, and in the middle of all this, you're going to find minor divergences. Okay, so what's not uncommon in a trend, now again, this is crude, all right, and actually let's go back to this real quick. All right, so on crude, again, look at the severity of the pressure on the book as far as market orders are concerned. All right, you can see where this is the number of additions and subtractions going on over here. All right, now as far as this pressure is concerned, we've got a lot of market orders to sell coming in here, and then we've got minor pullbacks. Okay, and what I was about to say is what's not uncommon in a trend is you'll notice you've got a lot of refuse that tends to lay on the order book. All right, so in other words, you're always going to have stacks of orders to buy as the trend is going lower. Okay, just sitting there and not moving, and as a result, what's going to happen is you're going to get your minor pullbacks. You're targeting these pullbacks for entries, but ultimately, as you go lower here, as far as your delta is concerned, prices are just are following suit. Okay, down here, same thing. Okay, higher low, higher low. Okay, up we go. All right. Now, why is this more one-to-one? Over here, we break apart. Again, this is more one-to-one because your market orders have a much more material impact in this market than they do in gold. Okay, as far as just your underlying movements are concerned, and this is what is really important to realize. When you're trading something like index futures, you're going to see a relationship that looks a lot more like this as opposed to the other way around in gold. Okay. Now, in a case like this, conversely, when we have a lot of low volumes in here, see again, your yellow bars are low volumes, low relative volumes. Over here, you'll start to see divergences. Okay. Now, it doesn't take a lot of limit orders in here because we have low volumes overall. There's not a lot of market orders to buy. Okay, so to push prices lower, so we make a basically a clean double, triple bottom here, whatever you want to call it, and then we're back on our way up. The second we get a little bit of green down here, look at what followed in terms of prices. So we have a huge spike up in price, just a tiny bit of green down here, just relative to everything that happened before it, meaning just market orders to buy, lift in the offer. Okay, and look what it does to prices. We just take off. Okay. In a market like crude or in index futures, again, this is what you're looking for. All right, you want to make sure that you are very well aware of these relationships. All right, now what's also interesting about this is that we've got both coming into play here, both regular and hidden divergence, in other words, as far as these two are concerned. So what I mean by that is our high here and our high here are basically one-to-one. Okay. So on a more macro scale, what does this tell me? This tells me that the limit order book is keeping prices low for the day. So where are they selling? They're selling on this leg right here. Okay, so this up to this point we're basically one-to-one, and we were able to match our highs here, more or less, okay, but as far as prices were concerned, no way. We're not even close. Okay, look at the difference here just in terms of the number of ticks. 57.33, 57.53. Okay, so we're off by 20 ticks. Okay, so that means the limit order side of the book was able to suppress prices 20 ticks in this entire up leg. Okay, now if market orders had their way, price would be trading up here, but that's not the case. And now market orders are making a transition, and it's the other way around for limit orders. Okay, so market orders decided to start selling here. Okay, and now limit orders are doing what? They're buying. Okay, because we're making lower lows as far as our delta is concerned, yet we're making higher lows as far as prices are concerned. Okay, so at this point, when you're trading an instrument like crude that is less liquid, you know, what is your path of least resistance? Well, at this point, you know, number one, we're in a range. Okay, so just to expect an immediate range breakout, you know, is a risky prospect overall. Okay, especially when we're trading around highs. If I were to buy here, that'd be quite a foolish thing to do, especially because we're right beyond our highest volume node for the day here. But overall, you know, the bottom line is you're looking for both of these things to line up. Okay, and here's why I say that, you know, it starts to become like performing surgery on an instrument like crude or index futures or things like that. What I'm looking for is both of these guys to be in agreement. Okay, so in other words, I've got a lot of, you know, decent amount of orders to buy down here. I'm not going to say a lot because, again, these are relative low volume bars over here. This entire, you know, what's been going on here. All right, so I know that just in general, these like to fill on a short-term basis. If you notice, wherever I have a yellow bar on my chart, anytime we've got a low volume area, shortly thereafter, at some point, it fills. Okay, so this fills, this filled, this filled, this filled, this filled over here, this filled here. Okay, you get the idea. All right, so I'd be cautious, very cautious of taking along here just based on that alone. And now when we're coming down here and we're starting to take a look at our delta again, look how high we were able to go on very few orders to buy, market orders to buy. All right, so you know, if this changed and we started getting, you know, a lot of market orders to buy, obviously, you know, at this point, you know, the path of least resistance is up. Okay, so we're looking for basically delta agreement and book agreement. Okay, this is no trade for me overall right now. I just, you know, there's nothing that's screaming at me right now. So that's why I'm not, you know, making a definitive call here. But, you know, overall, we were selling up to this point, and now we're buying in this area overall. So, again, you'll notice over here, this entire last leg higher, and going into this area, this is where the bulk of our selling came in. So usually what once was will still be around. So it's a fair assumption to make that, you know, we're going to see more selling pressure in this area from limit orders overall. But, you know, again, we're talking about crude oil here. You'll see that our delta is red right now, and yet we're not going down. Okay, so there's still, you know, that pressure to buy. Now, again, when you have a situation that's as clear as this, however, where everything is red, okay, as far as your delta is concerned, and prices are advancing, you know, that's basically your, you know, your perfect scenario as far as things are concerned. So in other words, there's a layer of confirmation here that's going to be a little more required than something like gold or currency futures. Okay, 6E and 6B, those are very limit order oriented instruments overall. Okay, so again, those are going to work very much like gold does. Okay, whereas crude oil index futures, you know, this is more the norm. Let's put it that way. Okay, another thing you can do. So let's say you're at a pivot. The book is in alignment with delta overall. This will drive you nuts if you're looking at it on an instrument like crude overall, because generally speaking, these change in the quickest of flashes. All right. What you're looking for over here is these outer columns. Now, this is the activity on what's going on the inside bid and ask. okay, or just any level for that matter. Um, what you're basically looking for are subtractions, okay? So right now I've got negative 51, negative 35, negative 12, negative 7, negative 28, and so on and so forth, okay? Anywhere you notice these subtractions, you're going to notice that price is having a much easier time going in that general direction. Okay, so when you're looking for an actual, precise entry, let's say you get a high volume bar, prices are about to break out, you could basically, go over to your DOM panel, look for orders getting pulled, okay, and that is going to be your path of least resistance at that specific point in time. Okay, I generally always like to wait for a pullback to a low volume area, or just standard support and resistance area. These are low volume areas. Prior to prices really taking off or doing anything like that. But again, this is just in quicker markets. This is another thing that you have at your disposal to look at. Okay, so again, it's all about the ratio of market to limit orders. This video is going long as usual, so I'm going to try to wrap up here. But hopefully I didn't ramble too much today. As most of you know, I'm not a huge fan of making videos, just because speaking isn't generally my deal. But I hope this more or less clarified a few things for you. And good luck in your trading, and we'll see you in the next one.